Everyone says, save your money. Your parents said it, your teacher said it, even your bank says it. But what if I told you that same advice might be the reason you're stuck living paycheck to paycheck? And what if the truth is, billionaires don't save the way you think they do? Let's uncover the shocking truth behind savings versus investing and dive into the real authentic data with proofs that just might change the way you treat money forever. Let me hit you with a truth bomb. If you're only saving your money, you're losing it. Yeah, you heard me right. That safe little savings account, it's quietly robbing you every single day. Thanks to inflation, bank fees, and the biggest lie we've all been told, that saving is enough to build wealth. Spoiler alert. It's not. Historically, the average interest rate for savings accounts in the US has been much higher, but the numbers have drastically fallen in recent decades. Here's a quick look. In the 1980s, savings account rates were as high as 9 to 10% APY, as the US was experiencing high inflation and high interest rates. 1990 to 2000. Rates began to fall to the range of 4 to 6% APY as inflation decreased and the Federal Reserve lowered interest rates to stimulate the economy. 2008 financial crisis.
Of the 2008 housing bubble and predictions of another housing market crash.
After the financial crash, interest rates plummeted even further, settling below 1% APY in the mid-2010s. Today, as of the most recent data, the average savings account interest rate sits at about 0.45% APY, with some banks offering as low as 0.01% APY. Yes, you read that right. That's practically nothing. In essence, historically, the value of savings accounts has steadily decreased, especially in the modern era where low interest rates, combined with high inflation, have made them a poor choice for wealth building. Let's say you save $10,000 today in your bank account. Feels good, right? Looks like a secure, responsible, and smart investment. But here's the math. Average savings account interest rate in the US is about 0.45% APY. Some banks offer even less, like 0.01%. That's a joke. Meanwhile, the average inflation rate over the last 50 years, around 3.2%.
Inflation is absolutely going to continue to be one of the headlines that markets are looking for. Inflation is likely going to be an issue.
So what does that mean? It means every year when your cash is secretly bleeding out, your $10,000 will be worth less than $7,000 in 30 years without you spending a dime, which clearly means that you're not saving. You're slowly sinking. Now flip the script with saying $10,000, but you put it into the S&P 500, which tracks the 500 largest public US companies.
You said the S&P 500 is going to reach 7,000. It's currently 5,900.
Historically, it's returned 7% to 10% per year on average. Let's use a modest 8%. After 30 years, your $10,000 turns into $100,626, and that's without adding a single extra dollar. Now imagine adding just $100 per month to that investment. That's like skipping Starbucks 5 times a month. You'd have over $190,000 in 30 years. And with $500 per month, we're talking over $900,000. This isn't a theory. This is math. This is real. This is how the wealthy compound their way to freedom. This isn't some trap I'm setting up for you. I'm giving you real life examples and doing the proper math. Take your time, do your research, and you'll soon realize how deep the rabbit hole goes. But don't think for a second this is a new scheme. People have been doing this for decades, building wealth the smart way. Just look at Ronald Read, a janitor who turned a modest income into a multi-million-dollar fortune. We've been so brainwashed by fake gurus and distracted by the internet that we treat wealth as some overnight miracle. The truth is that it is a marathon, not a sprint. Now, don't get it twisted. Yes, the stock market crashes. Yes, it dips, dives, and sometimes burns. But here's what they won't tell you on the news. in the long run, it has always recovered. And not just recovered, it's grown every single time. So why don't more people invest? Simple. We've been brainwashed to fear risk instead of learning how to control it. Schools teach us how to save, not how to grow. But here's the cold, brutal truth. The real risk isn't the market. It's doing absolutely nothing. Playing it safe might work if you're already rich. But for the rest of us, it's a slow, silent wealth killer, bleeding away our future while we watch from the sidelines. And the truth is, if you're only saving, you're playing defense. If you're only investing without understanding your risk, you're gambling. But if you're doing neither, you're just hoping. And hope isn't a strategy. Now take an example again. If you saved $10,000 a year for 30 years at a modest 2% interest rate, which is actually dramatic, compared to the 0.59% average return you're probably getting in most savings accounts as per the reports. But let's calculate it with 2%. That means you'd have about $412,000. Not bad? But now let's compare that to investing the same $10,000 annually with just an 8% market return, which is already considered on the lower end of market returns. After 30 years, you'd be sitting at about $1.13 million. Now, you can think about even higher returns for investing, but I'm giving savings a pure leverage here. Still, it is a $718,000 difference, and it's not because you worked harder. It's because you let the power of time and compounding do the heavy lifting. But please keep in mind that neither path is perfect. Saving is safe, stable, and liquid. You can access it in emergencies, but it's barely beating inflation. In fact, after taxes and inflation, that 2% gets eaten up fast. Investing, on the other hand, comes with volatility. The market goes up and down, sometimes dramatically. You will see red days, red months, maybe even red years, but history shows the trend always points up if you stay consistent and long-term. The only thing you need to do is think about it. Are you the one saying, I should have invested in Bitcoin back in 2010? And it's time for you to be one of the winners who invest and capitalize on massive growth. The time to act is now, before you're left looking back at missed opportunities. Just keep in mind that this video isn't hypothetical. It's backed by over past 5 decades of market data. So ask yourself, are you building a future or just waiting for one to happen? What more proof do you need to start? The numbers don't lie. But if you keep waiting, your bank account might stay flat while inflation quietly eats it alive, and your freedom keeps slipping further away.